So good afternoon, everyone. My name is Lane Jost. I'm the head of everyone's favorite acronym advisory at Edelman Smithfield. I've been in the ESG and sustainability field for almost 20 years, most of that time leading and developing different functions within companies, and now have the privilege of advising companies on ESG from risk and strategy to operation. I am really excited for this panel. I'm going to let the panelists introduce themselves really quickly, but I just want to say that we're all very familiar with the very exciting ESG backlash debate here in the United States. So we've made a ESG target to not discuss that on today's session, and we'll see how we achieve that. But really what I want to say is, the broader theme, I think that a lot of us in this room are attracted to this work, is this idea of unlocking the capital markets to meet pressing, exasperating global problems. And I think it's easy to get sidetracked in the minutia, in the acronyms, in the alpha and the beta. And so I'm really excited to have really two experts on this idea of unlocking innovative forms of capital and finance to actually solve people's problems, to help people's lives in meaningful ways, and to stay away from some of these sidecar debates that frankly aren't really helping us as investors, as people of this earth. So let me go ahead and have David, we'll start with you, and then Stefan, introduce yourself as well, and tell us a little bit about what you're working on today, and we'll take it from there.
Thanks, Lane. Hi, hello. I'm David Mikhail. See if I can recline back and still be heard. I really like to recline. I'm with the United Nations Capital Development Fund. Just curious, has anyone heard of UNCDF? I know Mr. Gitterman has, a few others. Great. We've been around since 1966. We are the catalytic finance entity of the United Nations. And I'm happy we're going to be talking about catalytic finance because I think given the markets that we focus on, which are the 46 least developed countries, I think in a parallel universe, we'd be calling them frontier markets. A major part of our focus is how do we catalyze capital, not just private capital, but frankly also public capital, ODA in particular, official development assistance. How do we apply that to markets that have been consistently and continue to be overlooked in the capital markets, specifically to close not the ESG finance gap, but the SDG finance gap? And and I'm anticipating people will talk about ESG is not SDG. I look forward to that conversation. And then before the UN Capital Development Fund, I also worked at the US Department of Commerce, specifically regarding the area of trade and how to support capital finance for the SME community, specifically in the context of global value chains. And I'm very happy to be here. Thanks.
Hello, I'm Stefan Pouyat. I have a fun bio and a boring bio. You want which one of the two? So I'll start quickly with the boring so that I take that away out of the way. I've been in the financial industry for 20 years, working for a company which is called Euroclear, which is a 33 trillion backbone. And I'm now working with the digital economists in trying to understand, how digital economy is going to be, digital transformation is going to impact our traditional economy and human-centric type of things. And I am serial entrepreneurs and I have multiple different things. And one of the things today is going to be about the so-called Tinder for investors. Okay, we'll talk about that. Matchmaking. And the name doesn't come from me, so I'm okay with that. Now, the more fun view. Right, exactly. And not only a married man, but that's my fun bio is that, I have four kids, and they said, "What on earth are you doing to save our planet, Dad?" Okay, good for them. So they give me a big challenge, right? I have about 15, maybe 20 years, if I really stretch it a little bit, to make an impact, and it's my own personal responsibility. Okay, and I think if we all think along this way, we will probably act slightly better. That's it.
So David, I want to start with you with talking a little bit about this idea that many of us, and I suspect folks in this room, this is not a new debate. So information security, inclusion, climate risk, climate change. I mean, those of us here in North America are impacted by climate change as we speak. A colleague in the room is going to be on an upcoming panel, was late today because of the wildfires over Ontario. But I think that the challenge is a little bit more severe in developing economies. We think about water risk, when we think about agriculture. So I think it's good to have some context here. I think David, one of the things we've talked a lot about is this idea of blended finance. And so, the public sector and the multilateral institutions can kind of think about problem solving, can think about models like the SDGs, but we need to work in blended innovation finance models. And so I know you've developed some tools like the SDG ETF that you all developed. Can you tell the group a little bit about that process? And then, Stefan, while you're thinking about that, I love your response in terms of how that's a model for kind of a more blended finance approach to some of these problems.
Thanks. I'd be remiss if I didn't mention that there is actually, and I won't volunteer, but there's an architect of the SDG ETF that UNCDF launched in late 2018 that was launched on the New York Stock Exchange. I think of blended finance, I think of the discussion around it the way 5 or 7 years ago, people were talking about blockchain, and there was all this debate and Sturm und Drang about, is it scalable, is it not? Meanwhile, it's just happening while everyone else is debating. And it's kind of the same thing with blended finance, where there's still this animated debate about whether it's truly impactful, whether it's truly scalable, whether you could fill the SDG finance gap with it. And meanwhile, it's being deployed, and including in models that we have overseen over the past several years. So for example, we have now 4 funds that are blended finance, ranging from loan and debt financing, specifically for SMEs, to debt and equity for infrastructure, for businesses that are tied to actually coral reefs. There was a question earlier this morning about, I guess, the inscrutability of nature assets. I wish I could have tracked this person down. So the fact of the matter is, you're already seeing these funds coming online. Target opens 250 euro, 250 million euro, 500 million USD. So they're coming online, they're there. So while the debate continues, you're already seeing these instruments coming into play. But separate from the scale point, I think we also have this debate about, we have to focus on transformation and not transaction, and we kind of have to focus on both. We can't lose sight of transaction. We have to focus on individual tickets, particularly because at the SME level, we've talked in the past about the valley of death. Our strategy from the UNCDF standpoint, it has veered away from microfinance over the years, and to focus on a ticket size of 250,000 to 2 million, because if you capitalize at that level, particularly SDG positive firms, then you see the development outcomes that can scale locally, and then hopefully 1 million flowers will bloom. So that is something that we've done, particularly as it relates to SDG projects, and we do it on our own loan and guarantee portfolio. We are the only UN entity that has what we call a unique capital mandate. We can deploy loans and guarantees. We are sector agnostic. So we target companies, we look for that missing middle, and we capitalize those companies in the hope that hopefully we can hand them off to a larger capital provider, they can scale, and then again, we hope to see larger development benefits. So we work at the transactional level, and we are also hoping to work at the transformational level through our larger funds. So I could talk more about that.
Well, I'm a fan of blend funds, and the reason I'm a fan is not because I like it. It's just because it answered real risk management issues. In international backbones, investors are extremely conservative, and we had some conservative investors this morning. They were talking about being careful where they put their investment, and clearly, most of the time, countries that needs large projects, if they try to issue that under local bonds issuance, nobody will buy it. It's just like there is no liquidity, it's a dead cow, so there's no attractions, nothing. So you need to blend. You need to uplift it, as we call it, collateral upgrade or whatever, right? You need to give actually the risk comfort that is required for international investors to say, okay, fine, now I want transformation, I want to help, I want to assist, and I feel that my money is going not to be at risk. If the money is at risk, money doesn't flow. Okay, so that's, we will talk more about this later as well, but I think that the local governments, the regulations, the protections of the assets, all of those things are extremely important. If you try to invest even in a very strong local private sector company, the risk is huge. So either you are hedge funds or whatever, you want to try to go for the big return and you take the risk. But at least investors in Europe, they don't do that, right? They're very conservative. They invest citizen money, pension funds, retirement funds, or we just mentioned earlier, insurance companies and like, right? So when we talk about deployment of capital at scale, we need to ensure that these risk management factors are very much taken into consideration. Now, about ETF and about ESG ETF, those two additional questions. Personally, I do believe that ETF have done a great job to help certainly manage the low hand side of a portfolio with where there was no need to take extra margins out of something that was really low. So cost and transparency was very, very important. And I think that transparency is just going to further grow. The all ecosystems that we have has a lot of opacity. That opacity needs to fade away slowly. And the ETF have been a big driver for that. So I think I praise them for that. Now, ESG or not ESG, I think we all talked about it this morning. It depends on the wind. Nuclear energy, I'm French, so I can say that, was a real bad thing 5 years ago, and now it's the top star of the energy that you can buy anywhere around the world. So, things just adapt because we play with the letters according to what feed us a little bit. So I pause.
So on blend, and thank you for all, I mean, you actually touched on something I want to address, which when we talk about blended finance, there are different modalities of it. And I think this is a conversation we've had where I think a modality that's already becoming more popular is guarantee facilities. And so it's a clear play role for the public sector. There's palatability, there's clear palette for it. I don't want my answer to be a commercial in the guise of an answer, or maybe I do. But UNCDF was the European Union has really been leading insofar as the utilization of guarantee facilities for SDG financing. We were fortunate to be the only UN entity to access a EU guarantee facility entirely for SDG projects. And so for us, it's a drop in the bucket relative to the figures you work with, 154 million euro. But when we're talking about the SDG finance needs in the countries that we're talking about, it can be significant. And so the guarantee piece, I think, is just going to be something that can really be a growth spike insofar as the public sector's role in this space moving forward.
So we are a little pressed for time, and so I really want to encourage questions from the audience. So we're gonna kind of talk for about 4 or 5 more minutes, and so get your questions ready. We'll open it up to the floor. But so let me just take a quick step back. So this panel, as many may have noticed, is actually titled Tinder for Investors. Depending on where you sit, that's cringeworthy or sort of brilliant. So let's sort of play in the middle, which is really where everything is played in the world. And so David and Stefan, I'm just riffing here. I think it's an interesting question. So just here it comes. So sell a investment in a developing economy with an SDG moniker to like a long-term investor. Anybody want to start?
Well, I think that no one will come.
What locks them? What's the locking mechanism?
No, the thing is that if we want to move capital or to redeploy capital where capital needs to be deployed, we have a lot of work to do. And I think that's why, working with people like the United Nations and working with people on the ground that understand the plumbing and the conditions and the criteria of success are extremely important. So we need to embark into this, and we need to make sure that on both sides of the fence that people are uplifting on the side of the countries, emerging market countries or whatever it is. They have to uplift their transparency. They have to uplift their cash flow mechanisms so that, again, they are creating the conditions for the cash flow to come. If that doesn't come, you just can't say simply you have to deploy capital in my country because you have to do this. No, it's never going to happen. So that's one thing. On the other side, they will never invest if they don't feel protected, as I said earlier. So you can clearly blending finance, but just working with the United Nations, working with someone who has this guarantee role is absolutely crucial. So that's what I'm saying. You need to put in place the ecosystem together, and that's what Tinder for investors. I think that's what Xavier Michon, I let you describe that, but he had in mind was to say, okay, if we work together in putting in place the ecosystem from the beginning to the end, then the cash will flow, right? And we need to protect the planet as quickly as we can. There is a significant need to deploy capital in those parts of the world. No one do it. And no one will do it unless we put in place the right ecosystem. So we need to start to be busy and to put it in place. Well, we have started already, but I'm just simply saying we all need to do it with you, and we need you to be with us. So I encourage you to come and talk to us, because that's something that we need to do all together.
So David, let's talk a little bit about some P's and shoots and structures that you all have put in place that you think sort of speak to this plumbing problem. Stefan, if I can borrow a phrase, that just to give the room a little bit more examples of maybe what this looks like, kind of in real time.
Yeah, I mean, so a few years ago, we launched, or we actually, let me take it back, because while we can deploy loans and guarantees, we can't work in equity. So we have to work with third party fund managers. And so one fund that we have that we call the Build Fund is essentially, it's a 3-level structure. There's a first loss capital that's provided by us. And if you think about it, it's kind of, I don't know if there's any Italian filmmaker aficionados, but it's kind of the Tower of Babel approach to a finance structure, where at the bottom you have the first loss, and the people that are coming, or the actors coming in at first loss, are us. But it's also development finance institutions. So, I mean, if people know CETA, if people know USDFC, they're coming in and providing that first loss. Because they understand their role. Then we have a mezzanine level in the middle that can interplay, and then you are buffeted at the top in terms of your capital. So to answer your previous question, one of our partners is Bamboo Capital Partners, and he was asked the same question about Build, and basically his answer was, okay, if you're looking for 7% yield, look somewhere else. But if you're looking for 4% with your first loss, with first loss capital that's protecting you, we're your fund. So I think that's where the play of concessional capital comes in. I think there is to steal from the foreign policy space, a very realpolitik view of all this, in the sense that we understand that even though the SDG finance gap for the poorest or least developed countries is quite small relative to the trillions of dollars in global markets, you still need to incentivize. And you need to do that with the risk capital that can basically absorb the lion's share of the risk. So, I mean, and that's basically a model that we've seen in terms of our other funds too. We have a fund called the International Municipal Investment Fund. Our partner there is Meridium, and where it's basically, again, where we are creating buffers in terms of risk capital through first loss, but also through a connected fund that is capitalizing basically stronger bets in developed markets, and then we could basically offshore the risk to this other fund that focuses on the LDCs. And so we were just talking that I think I hope it wouldn't surprise this audience, but I think there's a level of sophistication as it relates to the financial structuring that you're starting to see at the UN, and I think you're going to start seeing more and more. Particularly because, I mean, I work in an organization where my colleagues are not all people who have done God's work of digging ditches in the field. They've worked at Standard Chartered, they've worked at financial institutions, and now they're bringing that experience. And I said I wouldn't say this on the record, but there's a brilliant colleague I work with who basically was thinking, what if we create a CDO, except we do it for water finance? And it's like, why can't we do that? And we were having this conversation, and someone else said, well, do you want that to be, A rate? It's like, no, just risky enough that it's palatable. These are the same conversations that have been taking place in the private sector. They're migrating they're migrating now into the UN space, and obviously not at the same level of sophistication, but it's definitely growing.
Let me ask one more question, and then I'm going to open it up to the room. And I'm going to pick on you a little bit, David, but I want Stefan to respond. So when you're giving the example, when you were giving the example of Bamboo Capital Partners, which I thought was really interesting, you talked about a very common paradigm in sort of impact finance, which is this idea of, well, we can't give you market returns, but we can give you slightly below risk-adjusted return, but you kind of get the societal sort of fairy tale goodiness thing, right? And so I want to challenge that a little bit, Stefan. Like, do we think that kind of, lower than market returns for catalytic finance is the way to go?
Not at all. I don't believe that. I think that unfortunately, we are driven by return, and that I have the luxury to work in a very large ecosystem of startups. They are amazing startups, and with massive returns. Because in fact, the climate deterioration also creates completely new big opportunities. But of course, we don't understand them because we are here, and we don't hear what's going on over there because we are again here, right? So people don't find each other. But the ideas that some of those kids have, I mean, I say kids, sometimes they are older than me. It's not a question of age, but the return are definitely there. The problem is that people who have capital, they are scared. It's too far, it's too complicated, it's at the other side of the world, it doesn't comply to their own local matrix and so forth. It's not backed up by Harvard Business School or whatever, MIT, and so and therefore the dialogue doesn't take place. But the returns are huge if you find the right opportunities. So I am convinced that the world will only functions if you match profitability with good actions. Okay, but there are a lot of people who are using that. By the way, I'm one of the person who do not like much the way the ESG industry has evolved. I was extremely keen on ESG, and I am still very keen on ESG, don't get me wrong, but not the way the industry has evolved. It has evolved as the biggest consulting fee industry of the world that try to rip off people rather than to do good. And the regulators and everybody included, because actually we are increasing the pile of complexity to try to do the right thing simply, right? I mean, this common sense, helping people who have problems of having food access and all of that doesn't require a massive amount of compliance and certification and all of that. Those people are just dying. So I think, I'm working with Harvard Business School and Stanford plastic surgery people. Those people, they are amazing. Amazing. They have developed an entire program. They use phones like that. They put phones like this in African people, right? The African plastic surgeries. They are like that. And I didn't know that because again, I'm living in a comfortable zone. I didn't know that one of the biggest handicap consequences of African life was burning skin. And the reason it was burning skin is because the mom and everybody else, right, are around the cooking stuff and whatever it is, it's just that kids get burned. The Red Cross comes every 3 months. If you don't fix the things in the last 24 hours, you get handicapped for life. And handicapped for life means society all together, we have to pay for it, right? So fixing that in less than 24 hours is extremely important. So they teach, they do this, they use AI, they use all this technology. I love that. To do good, to help people that are just burned in those villages, beat by those villages on the spot, and they do the surgery. In France, you cannot do that. You have to be certified by the Medicine Association. You have to do this. We become a little bit crazy people. We don't realize how complex we make our own world, as opposed as just doing good. Just help those people. Stop being academic and you know how many medicines and stuff like that went through all this education stuff and badly act. I prefer to save people on the ground, even if they might have not gone through all these educations, and I have done a lot of education myself. Okay, so I stop here, but I'm just simply saying there are fantastic opportunities out there. And we need to try to bring those opportunities. That's why it's called Tinder or whatever for investors, because those are the opportunities. And I want to bring those opportunities to this table so that you as investors, you can just use common sense. And I need United Nations and others, because I know that you don't want your money to be wasted, right? So I need to protect your money. But if I can protect your money and I can give you the right opportunity, we have the best future that we can develop together. Thank you.
I think we have time for time for 2 or 3 questions. Who wants to start? You, sir.
Just what you're talking about in this thoughtfulness of capitalism. I'm a capitalist. I don't know if that's good or bad, but it got us to where we are. But I think this thoughtfulness of a conscious capitalist, planet, people, profits, with all balanced is really hopefully our future. And I think that's what you're talking about. Bravo.
No, absolutely. As I said, I don't deny capitalism. I said I don't, because I think that philanthropy goes to a certain extent. And I'm French again. I'm socialist. Okay, as long as you have money in your cash account. No, but as long as you have a lot of money in your banking account, you can be socialist. The day is empty,
Who's next?
David, I have a question on how the UN does their ESG due diligence on investments. I used to work at the DFC, and we did really intense ESG due diligence that at times I felt like made it difficult to make really impactful investments. So I'm curious about how the UN approaches that.
I guess my immediate thought is that it's our alpha and omega remains the SDGs. And so I think Pedro, who oversees the Joint Pension Fund, basically said the same thing. And for us, I think the SDGs are seen as this, it's just this 17 goal rubric. And actually, I think there's 162 indicators. It's actually quite involved. So for us, there's ex ante and there's also ex post. So I guess on the ex ante side, one example, I'll just speak more generally, say the UN Global Compact. So this is an entity that exists within the UN system that is basically serves as a clearinghouse for private sector partners that we can engage with. And so the idea would be that if they're part of the Global Compact, and it's not just that you have certain practices, it's that you have to report and things of that nature. And so there's the ex ante. On the ex post, to be honest with you, it's frankly, I couldn't speak for the entire UN. And I think you're going to see a lot of diversity in terms of that question moving forward. From the standpoint of UNCDF, we've always had internal systems that relate to is it touching our mandate? Is it touching the SDGs? But is it also financially palatable? We have an internal system that we're now working on scaling across all of our investments. There isn't a one size fits all, at least as it relates to the UN. And I think what'll be interesting is as more UN entities start taking on capital instruments, which I just think is going to happen. Are we going to have a broader centralization of that point of like, how do we ensure that everything is SDG positive across the entire UN system? So I know how we do it, and we have our own internal system. How it scales across as we get to 2030 is going to be an interesting question.
Yeah, it's a really excellent question. Thank you so much. One more question, and unfortunately, we've got to let these gentlemen go. Adrian.
Yeah, we have a question from somebody anonymous saying, is it wise to conflate fiduciary management of ESG risk with social responsibility? Doctor saving people is non-function of ESG.
I think it's too much of an intellectual question. I'm not sure I understood the question.
Well, basically they're saying, are we conflating ESG with emotional feelings of, you can tell a nice story about a doctor does this, that, and the other, but actually we're talking about returns, and our fiduciary duty is to deliver returns on investments.
Okay, but we heard about the firefighter this morning. To me, it's common sense. The planet is going not necessarily in the right direction. And so if we have more fire, we will have more firefighters, and we will have more deaths of firefighters. And so, if I were responsible for fiduciary duty at the firefighter centers, I will try to put my money to prevent any fires to go on and on and on. So that would be my priority, because that's the best way to save my people, is not to have fire, right? So I think that I don't know so much about emotion. I was just giving an example of very pragmatic business cases where growth and potential returns are there, because you fix the fundamental problems of disability and increase disability in regions of the world where you could use these assets, people assets, in a different way than just to support them for until they die, basically, right? So I don't know. I don't know so much what to say on that specific question. I think the fiduciary duty sometimes is an excuse. I'm just talking about my experience in Europe here, and that's the type of conversation I have today. Is that we have a lot of long-term investors that hide behind fiduciary duty or board policies and the like, just not to deploy capital where the capital needs to be deployed, right? So I wrote a piece of paper. It's called Capital for the Common Good, that I circulated at the G30, which I encourage you to read. I think we have this responsibility to try to do the right thing, and we have to grow up. We cannot hide behind the scene and just say we should do something, and basically we say our policies can't allow us to do that. That's my answer.
I'll just be really quick. I mean, just to build on that point, I mean, I guess a practical example, and I'll just use the exciting world of parametric insurance. Another project we're working on is creating, and this is something you always talk about, which is ecosystem. We're creating basically an ecosystem approach to how can you create insurance pools to finance climate adaptive infrastructure in the least developed countries. And how do you do that? Well, it's not just that you bring the insurance company, but you also have to bring in you have to bring in multiple pension funds and things but you could do it at a point where these catastrophes are actually still insurable, and you're also leveraging it towards a project that could be long-term and produce steady yield over many years. And so there is a palette. Again, not hardly the most exciting example you're going to hear today, but I think it's an example of how there is a practical point to marrying SDGs to your investments in terms of long-term sustainable investment and beyond that. Yeah, thanks.
Well, I think that was really great. Please join me in thanking our panelists, and thank you for